Good morning, everybody. It's 10 o'clock, so we'll start. People have travelled a long way, so thank you. Pardon? Good morning. Good morning, David. Okay, the meeting of the Charities and Trust Committee. First of all, apologies. I've received 2 from Mark Whittington and Thomas J. Okay. Okay, next item, declaration of interests. Does anybody have any declarations of interests? Okay, thank you. Okay, item 3, minutes of the meeting held on the 18th of April 2024. They have been circulated. Does anybody have anything to say about them? No, thank you. Okay, we go to the work of the agenda. We have 2 items at 5 and 6. Which I'm going to combine because they are related. If we have any discussions then and any voting, we can do that at a later stage. But we'll start with item 4, which is Stafford 14 to 19 partnership, the business plan. Over to yourselves.
Thank you, Chair. As in previous years, my report to the committee makes requests for funding support on behalf of Stafford 14 to 19 partnership. I'm accompanied as usual by the current chair of the partnership executive group, now Matt Mason from Sir Graham Balfour High School, and the partnership manager Maggie Smart. I've worked with them both in their review of the progress of previous year's operational plan and with regard to the partnership's new 5-year business plan for 24-29. Following approval of a sum of £172,528 for 2023-24, the partnership have, as ever, ensured cost savings are made wherever possible, and so the actual funds transferred for that year were over £32,000 less than previously approved. The partnership executive group have prepared a new 5-year business plan, updating their student number predictions and forecasting their finances for the next 2 years initially. The partnership are mindful that there are limited resources available to bid for and have continued to review finances and programme delivery. And despite increasing staffing and pension costs and increased running costs, they're now making a lower level of request for 24-25 than approved in principle at the meeting in June 2023, while still delivering a service that endeavours to improve the life chances of the young people of Stafford. This has mainly been possible by changes in their partnership course delivery and removing some courses where take-up has been low. The partnership remain committed to working collaboratively to benefit the students of Stafford and to continue to offer additional activities to further engage these young people in Key Stage 4 who are at risk of becoming NEET, or to further challenge those who are gifted and talented. I'm supportive of the partnership as its continuation enables young people from the majority of schools in Stafford to access a broad post-16 curriculum offer while still being able to retain the strong pastoral support of their home school who know them well. Given some of the challenges faced in recent years, this is often key to young people's success. As you'll see from my report, I'm recommending to the committee that you consider for approval the funding request to Stafford Education Centre charity of £159,823 for the 24-25 year and £160,188 for 2025-26 should there be sufficient funds available. I also request that you approve the County Council's Assistant Director for Skills and Employability to be authorised to approve the release of those funds subject to successful delivery of the 24-25 operational plan. As I mentioned earlier, I'm accompanied by Matt, and he'd be happy to provide you with an overview of the impact of the funding provided over the last year and also answer any specific questions you may have about the partnership, the business plan or the funding request.
Okay, thank you everyone. First thing I'd like to say is that on behalf of my fellow head teachers, we are really grateful and appreciative of the support that we get from the charity. And the reason why we are so grateful and appreciative for this support is that the impact that it allows us to have educationally, also add economically and socially to that actually, and boosting the life chances of the young people that we teach. Educationally, it allows us, to put a really aspirational offer, access to the country's best universities and best degree apprenticeships right in the heart of schools and local communities all across Stafford. Economically, we believe that we make a significant contribution to the Stoke and Staff's local skills improvement plan with regard to the pipeline of highly qualified graduates who hopefully come back to the area after they've done the degrees after they've left our schools. And socially, it's also the right thing to do in terms of the work we're doing with raising aspirations, reducing the number of people who are not in education, employment or training. That has actually lowered the number of those kids is actually lower in partnership schools and in the rest of the Stafford district. And you've got schools in the heart of the communities that they serve, encouraging the students to be aspirational, to push themselves and to do the very, very best they can. And they do that by studying A-levels where they know and trust the staff. And again, that's vital at the heart of some of our communities where kids may not have those levels of aspiration or support coming from home. In terms of academic success, the schools in the partnership are academically successful. 3 out of the 4 schools in the partnership do have exam results above the Staffordshire average at A-level. That's despite our highly inclusive entry criteria. We do send large numbers of students to high-tariff, highly regarded Russell Group universities. That was just under 50% last year, and we're now really establishing a strong track record in that area. And other students, not to say that's the be-all and end-all of higher education, other students do go on to degree apprenticeships, and they also go on to some excellent courses offered by local universities, especially at Keele and Staffs as well. We're keeping more students than the Staffordshire average in education than the district average over the last 2 years. So we've got quite a wide-ranging, fully rounded picture of academic success there. And one of the reasons that I said at the start that my colleagues are so grateful and appreciative of the support is that it does allow us to widen participation. We offer 27 different courses across our partnership schools. That provides a wide variety of routes onto, whether it's higher education, further education, apprenticeships for students. We also do a lot of work with enrichment as well. We have visits all over the country. This year we've had students go in the last few weeks actually, down at Buckingham Palace to receive the Gold Duke of Edinburgh Award. They're off to universities, they're attending science competitions, maths competitions, got a wonderful range of work experience. And it's this funding from from this charity that really does help us to do that. So thank you very much.
For the last 14 years, I was a governor at Cardinal Griffin, which is now part of the Paisley back, which is same as Blessed William Howard in Stafford. So I know how difficult it is. And the need for collaboration with other schools at 16 to 19, really, to run the majority of courses, particularly things like modern foreign languages, where you might only have one take-up, whatever it is. So thank you for those great results. Anything else from the other 2 councillors?
I was just wondering, with the increased number of apprenticeships becoming available, how that was affecting university placements as opposed to apprenticeships. Whether you had any thoughts to say on that?
The increased number of apprenticeships that's coming on offer now is, in my view, it's a good thing because it offers students who may be worried about university debt and things like that. It does offer them a route through a high-quality apprenticeship and getting, a degree qualification alongside it. We strongly support applications for the degree apprenticeships, and we're looking to wherever we can. We have got good links with local degree apprenticeship providers as well. We do strongly encourage kids down that pathway.
When you're of a certain age, you remember things from your past. I remember a number of my friends who very successfully went through sandwich courses where they did half-time doing on-site training and half-time at advanced technical colleges, as they were there now, universities, and ultimately got degrees from that. I wonder whether there was a move back again with the increase in apprenticeships to that sort of scheme.
I agree completely. There is at the moment. There's a lot more pathways than ever before through into post-18 education and employment, and there's there's developments in Stafford at the moment. The Stafford College will be opening up an Institute of Technology soon that will offer, I think, a lot more of those pathways in the local areas. There's a new qualification called T-levels that are coming through as well, which is it's as you described. Excuse me, it's as you described, the kind of that mix between in classroom or in workshop learning and then going out practically and doing it. So yes, what you described there, people doing post-18, they are bringing elements of that forward to post-16 provision now as well.
Last night, so I'm not totally brief with the paper. So I've actually been doing some Googling, and I sometimes find that I get a wider view rather than just read the council papers. So I've actually did some Googling to have a look at what you did. I think any time when we're working with young people is massive, Mr. Chairman, and it genuinely is for somebody who's worked with young people for up until I got too old to do it, which is definitely now. You realise the importance that it makes. So I'm fully supportive of this, Mr. Chairman, totally and utterly.
Helen or Elizabeth, do you want to add anything?
I will just say, Chair, sorry. I'm Mel, yes, sorry. From a financial perspective, we have got the funds to award the monies requested today, if you're so minded. I think we get about 160,000 now in income on this particular charity. So the fact that the partnership are matching the level of income, we're not seeing requests from anywhere else at the moment. So, and there is a bit in the kitty still left, as it were. So we can support the request for this year and the provisional request for next year as well, if you are so minded.
Thank you. There are 4 recommendations. I don't propose to read them all out due to the length of them. I'm in favour. The other councillors? Moved. Okay. Recommendation is moved and seconded. We agree with it. Good luck for the next 12 months. Just keep up the good work, and next year come back with even better story. Thank you very much.
Thank you very much.
Thank you. Thank you.
Thank you very much, everyone. Much appreciated.
Thank you, everybody. Okay, we'll now take items 5 and 6 together. I'll hand over to Melanie for introduction.
Thank you, Chair. This is about the investment of the permanent endowment of the charity funds. We've just obviously, apologies, we just heard how the income that the investments generate can make a real difference to students and in the community. And so what we do is we have to look after that permanent endowment, and we've currently got about £12 million of permanent endowment across the 10 charities that we administer at the County Council. One of the things it's good practice to do every so often is to sort of ratify the way we invest that money. And for a number of years, for as long as I can remember, we've always invested the money in the funds of CCLA, which is Charities, Churches and Local Authorities. We can't really warrant more than one fund manager because we have sort of relatively little funds in comparison. But the paper in front of you today really gives you the evidence as to why we would recommend continuing to work with CCLA for the investment of those charity monies. It is just a permanent endowment, as I say, and that generates the income. You have a responsibility under the Trustee Act 2000 to, oversee how that money is invested as the custodian trustees, and the managing trustees, which are the committees at the various schools and like the 14 to 19 partnership, have the responsibility of allocating that income on a day-to-day basis. They know where the money is best needed, where it will best make effect. So your duty today is really around ensuring that the safety of that money, that the money is invested, that permanent endowment is invested well with a manager that you support, and a manager that really understands charities. And we've invited Elizabeth here today from CCLA to talk to you about the CCLA funds that we invest in. If I look at your papers, you can see on page 61, we've gone back to some various public documents that we can find. And CCLA there are the sort of the number one charity manager. They have the largest number of charity clients, and they have the largest value of investments, which is not always the main reason you should invest with somebody, but they really do get charities. Table 2 on page 61, again, the size of their funds, they can do a lot more with the size of their funds. They can invest in more asset classes to give you the diversification that you need under that sort of custodian trustee lens. Their fees are comparable. They have a good level of income to distribute, which is really the most important thing for the charities that we look after. They need that income, they need that steady income. And you can see there in the table that the distribution from CCLA has been quite significantly higher than the other funds. And also we want the performance, we want the capital to grow. As the capital grows, it generates more income. So there's a whole raft of things there. And you can see from the first column on table 2 that CCLA are really head and shoulders above the nearest competitors. The other ask in this paper today on page 62 is around the range of funds that CCLA offer. Elizabeth will talk about the exclusions from the COIF Charities Investment Fund, which is the fund in which we are suggesting that we continue to invest as our main investment vehicle. But we're also getting some queries around ethical investments. And I think what we're asking for today is, we're not saying we want to carte blanche move everybody out of the one fund into the other. But if we get a charity that's so minded, a bit more ethically minded, that we have that ability to flex. And again, on page 62 in table 3, you can see that the ethical investment fund is a lot younger actually than the Charities Investment Fund, but the assets are starting to increase, which is obviously reflective of the way people are now thinking about ethical investments. Everything else is pretty similar. The fees, performance will flex a little bit when you start excluding certain stocks. There will always be a bit of variability in performance. But generally, we have no concerns about any charity that said, could we invest a little bit more ethically? I'm going to be quiet now, and I'm going to hand over to Elizabeth to take you through the presentation. And then we'll come back to have a discussion about the recommendations, if that's okay, with the committee. Yeah.
Have we had any pressure put on us by any organisations to act more ethically? Or is it a decision we're making ourselves?
I think with my pension fund hat on, recognising how responsible investment is becoming a bigger and bigger issue, we haven't had any requests, but I think it's good to put the plumbing in place in case we do.
Thank you so much. I think, there we go, look, the slides are loaded up. So I won't go through every slide in detail, so don't worry. I appreciate this is part of a bigger meeting. But just by way of introduction, I'm Elizabeth Carter. I am Client Investment Director at CCLA. So my job at CCLA is to build a relationship with our clients and talk to you about your investments that you have with us. And I've been at CCLA for 20 years next month, so that feels like quite a point in the road. But just a bit about CCLA for those of you that aren't familiar. We, as Melanie said, we are the largest fund manager by assets under management and number of charities that we look after. So we manage about £14.5 billion worth of assets for the not-for-profit sector, for churches, charities and local authorities. And we've been doing it for over 60 years. So it's absolutely core to what we do. We're not like other investment managers in that it's a bit of what we do. It's core to what we do, and we're not going to sort of step away from the sector. And it really is fundamental. So we have a fundamental understanding of charities. So that's in terms of the portfolios that you have with us, we administer around 10 charities, and they all have separate accounts with us, and they're predominantly invested in the COIF Charities Investment Fund. I won't go through all in detail, but just to give you an overview, as we've obviously been hearing about the partnership, if we just focus on the Stafford Education Centre charity. So 5.966 million is the latest valuation. So when the charities have their accounts, they've purchased a number of units. The market valuation is dependent on the underlying asset valuations and the unit price to give that valuation. So that's typically where you will see volatility. Where you won't see volatility is around the income. So we recognise that as charities, you need that capital to grow over the long term, but you also need to have an attractive level of income to be able to distribute and give to current beneficiaries, and that market valuation will grow over time to provide for future beneficiaries. So the investment fund is very much designed to be even-handed between current and future beneficiaries, but with that steady and rising income. So hopefully that helps with budgeting, because whilst the forecast income isn't guaranteed, in the time that I've been at CCLA, we've always paid what we've said we were going to pay in the preceding year. So the fund is a charity in its own right. It is ring-fenced, it is held by a corporate trustee, and it has all the tax advantages as charities have in terms of income tax and capital gains tax. But the fund is an actively managed, very well diversified portfolio, largely invested in equities, but we'll come onto that asset allocation in a bit more. So we've got all of the portfolios in here. Again, I won't take it through one by one, but in total there's about 12.46 million on the latest valuations. Slight difference on this, on the Brood charity, in that they also have accumulation units. So most charities take the income, but you can also have accumulation units which roll up the income in the value of the units. So just flicking through all of the different accounts, happy to take questions on any of them if you'd like. But just focusing on the objectives of the investment fund, the fund is trying to deliver a long-term return of inflation plus 5% before, plus 5% before costs, which is effectively CPI plus 4% after costs. So why are we trying to deliver CPI plus 5? CPI to protect the assets against the erosive effects of inflation. It allows for about 3% of income to distribute to current beneficiaries in the form of income, and then it allows for 1% growth each year, and then there's a sort of 1% for costs. So it's trying to be even-handed between current and future beneficiaries, but also having an ethical policy on the fund. So there's nothing in the fund which could draw criticism or embarrassment. So the main exclusions on the investment fund are around tobacco. There's a screen for things like online gambling, which is seen as the most pernicious, but also pornography and indiscriminate weapons. So those weapons which are outlawed by UN conventions. So I can talk about performance, but I'll do it quite quickly. So the last 12 months, we've seen strong returns. The light blue line is equities. So equities have been strong. Why have they been strong in the last sort of 6 months, really, from the start of this year? It's because that pink line, which is inflation, is now under control. So we've all got used to having inflation at double digits. Because interest rates have been put up centrally, you can see that grey line. That's the rise in interest rates. So interest rates have now peaked, and given that interest rates have peaked and so has inflation, that's good news for equity markets. So that's why we've seen the rally really since the start of this year. It did pull back a little bit in April because of interest rates not falling as quickly as markets had expected at the beginning of the year. So at the beginning of the year, expectation was the Federal Reserve might have 6 interest rate hikes. It now looks like there might be 2. So we're very much at the table part of Table Mountain, as described by the Bank of England. So interest rates at the peak and will come down, but not like the Matterhorn. So a slow decrease from here. So inflation has peaked, but it's still worth noting that it's sticky. So it's higher than the Bank of England target in the short term, and we think it's probably going to stay around this level. So very much important to protect the assets against those erosive effects of inflation. The other assets on the chart are, the green line is property, so we use that as a proxy for infrastructure and UK commercial property, largely moving sideways because we've seen a yield correction with bonds. So cast your minds all the way back to September 22 and the mini budget. where we saw bond yields spike to over 3% in a matter of days, we'd been absent bond markets because we thought yields were too low, the potential for capital loss too high. That was a buying opportunity for us to go back into bonds because we saw this spike in yields. But what it meant for the wider market was if you can get 3% from a 10-year UK government bond, is 5% from property enough, or do you want higher yields? So for the last 18 months, we've seen this sort of yield reevaluation, which has effectively meant a fall in the pricing of assets to allow for yields to rise. But we think that's washed through now. We still think there are good assets out there to be had in terms of infrastructure and property. So the reason that I'm rambling on about different assets is that the investment fund is invested in all of these different asset classes. It isn't just an equity fund. So we have multiple sources of returns. It's very diverse in terms of asset classes, but also within asset classes and the number of holdings that we have. So in terms of returns, for the 12 months to the end of March, after costs, the investment fund delivered a total return of just over 12%. And we also show it annualised over the last 3, 5 and 10 years. So the 10-year figure is that over the last 10 years, the fund has delivered over 9.3% per annum. And we show that against the ARC Steady Growth Charity Index, which is the peer group, so other charity funds you could have invested in. We show it against the comparator benchmark, which is a basket of indices to give you an idea of how underlying asset classes have performed, and against that target benchmark of inflation plus 5%. So you can see good long-term returns. In the shorter term, it's been difficult to deliver CPI plus 5% because inflation has been so much higher, but now we recognise that it's falling back. We think that that CPI plus 5% continues to be achievable. And in the shorter term, slight underperformance for the benchmark, because the fund doesn't invest in traditional oil and gas stocks and more cyclical things like banks, for instance, in the portfolio. So when cyclicals do well, as we've seen at the start of this year, there can be some underperformance. But you can see good long-term returns. But it's worth noting that those returns aren't linear, so it's not 9% every year for 10 years because there will be periods of volatility. But even through periods of volatility, the income has been maintained and grown. So through the financial crisis, the income on the fund actually grew, even though valuations were down. So that's very much the way that the fund is managed, to allow you to continue to distribute and rely on that income, even if the market valuation may be volatile. And we can see that in this really dull chart, which just shows the dividend in pence per unit and how that has grown over time. So what does the fund look like? This is the asset allocation of the fund. So it's a multi-asset, actively managed fund. To deliver those above inflation returns, it's predominantly invested in equities. So equities making up the largest proportion of the asset allocation. And then we have those other assets to diversify equity market risk. So we have cash and bonds. Infrastructure is investing in third-party funds, investing in things like ports, bridges, harbours, for instance. Property is through our own Charities property fund, which represents about 60 commercial properties throughout the UK. And then there's other things like contractual income, so student accommodation, and historically we've held things like music royalty funds. So in terms of the equities that we're looking for quality growth companies, so companies with strong fundamentals, companies with high return on invested capital, strong free cash flows. We don't like companies with too much borrowing, because obviously with higher interest rates, that has to work harder to source that debt. And particularly we like companies with a competitive position, so it's hard to break into their space. Think Microsoft and cloud computing. So just showing you the types of sectors that we like. It won't be a surprise to many of us that the tech stocks are driving markets. You may have heard of the Magnificent Seven, which are those 7 tech stocks which are really driving the US returns. In some cases, a quarter of the market returns are coming from those 7 companies. So we like companies like NVIDIA, so making the semiconductors. We like software companies like Adobe, Microsoft. We also like healthcare, so fairly defensive stocks. We think about aging populations globally, the need for increased healthcare. We like the companies making the new knees, the new heart valves to make recovery times from operations quicker. So things like Intuitive Surgical and Medtronic will be in there. I won't go through every section because we'll be here all day, but of note, we don't have any traditional oil and gas in the portfolio. We see them as very capital intensive. It's becoming more expensive to get it out of the ground. We prefer capital light businesses. So we also don't have any mining companies, and we only have one utility company in the shape of Next Era Energy, which is renewable energy in the US. So again, we're not sort of worried about some of the issues with utility companies that are going on within the UK. But any one time, we have between 80 and 90 equities and around 30 to 40 other assets in the shape of property infrastructure funds. So just on to the next slide, we can see the alternative, the other assets in the portfolio. Just to point out the bonds, so we have about a half weighting to bonds. The benchmark has about 15%. We've got about 8%. That's because there is still some data pointing towards global recession. It hasn't materialised, but that's our sort of hedge against recession. But we'd been absent the bond market for probably the best part of 10 years until we saw that spike in yields. So it is an actively managed portfolio. We will not always, we will make decisions that don't make us look like the benchmark because we are index agnostic. We're just completely focused on delivering inflation plus 5% over the long term, not what everyone else is doing in terms of their asset allocation. So just quickly touching on good investment, so sustainability. And the way that we manage money is in terms of act, assess, align. So ACT is recognising that markets can only be as healthy as the communities and planet which it serves. So this is about trying to drive company change through engagement. The assess part is recognising that changing regulation, legislation and consumer choice is going to harm unsustainable businesses. So this is about understanding risks within businesses which, if they blow up, could impact the share price. And the final part is align. So this is recognising that this is the charity's money. We're just the guardians of it, so it has to reflect the charity mission. And that's where the exclusions come in. So on the investment fund, as we mentioned, the exclusions are largely around tobacco, online gambling. Those are hard-coded into our systems. We can't accidentally buy a tobacco stock. And that's the only bit which is different between the investment fund and the ethical fund. So they have the same investment objectives. The asset allocation is broadly similar. It's managed by the same team, but there are some further exclusions on the ethical fund than the investment fund. So they're both ethical. We just couldn't call them the ethical and the more ethical fund when the ethical fund was launched 14 years ago. So the biggest difference around exclusions is that the ethical fund also excludes alcohol. So the investment fund can hold Heineken, for instance, the ethical fund can't. And then there are also some tighter restrictions around armaments on the ethical fund, so things like screens on handguns and a screen a bit wider than indiscriminate weapons. But everything else is the same. So the assess part where we're looking for extra financial risk, that's just part of our investment process, and that would apply to both funds. So for instance, just to give you an idea, we've never held VW in any of our portfolios. We couldn't have predicted the emission scandal at Volkswagen, but we did know that they were in the bottom 5% for corporate governance. So assessing environmental, social and governance factors for us is just a way of understanding extra financial risks within businesses, which may not be reflected in the share price. And then finally, the ACT part is really trying to drive change in companies. So we want to invest in good companies and we want to try and help them to become better. And we do that through voting at AGMs, engaging with the companies on issues around remuneration, diversity. But also we think because of who we're investing for in terms of churches and charities, we need to look a bit wider and try and deal with some systemic change as well. So trying to act as a catalyst for real world change. And we do that through a number of engagement programs. We've just listed 3 of them out here. So whilst we don't invest in traditional oil and gas companies, we have exposure to renewable energies through the infrastructure assets. But we still continue to engage as part of Climate Action 100+. We do see climate change as the biggest risk to investment markets. We have some engagement programs around modern slavery. We think modern slavery exists in all supply chains, so it's about finding it. Our chief exec's been quite vocal in the last week around Shein trying to list on the London Stock Exchange because they've got real issues with supply chain and modern slavery. And we don't want to become the sort of default where when you can't list in other jurisdictions, we don't want to be the dumping ground for not very well run companies. And then finally, our mental health benchmarks is looking at how companies, the largest in the UK and globally, how they treat their staff around mental health and really looking to drive change. And you'll see on there that 42 companies have improved their ranking. So that equates to 7 million employees having a better approach to mental health. And I think that's what's key. If you can see, I said right at the beginning, I said we manage about £14.5 billion worth of assets. The modern slavery work is backed by £14.8 trillion worth of assets. So it's about coalescing like-minded investors to get behind these programs. And bringing it down into a sort of an individual case, we're doing a lot of work with Amazon as well, engagement with Amazon, because obviously there are real issues in many of the distribution centres, particularly in Rugeley and the Coventry distribution centres, about how staff are being treated. And we've put resolution to Amazon, again, with other like-minded investors. So that's going to be a long piece of engagement. Eventually, if we don't get anywhere, we would divest, but we would hope that we can make some improvements with Amazon, and we've seen improvements on their mental health work. So just really to summarise that this is our approach to good investment, which applies to both funds. The only difference is around the exclusions. So there are the exclusions for the investment fund that we've talked about. The ethical fund has a few more exclusions. You can see there's a lot more text on that slide and it's much smaller. But the main differences are around gambling per se, so not just online gambling, but alcohol is the biggest differentiator between the two funds. There are also some screens on, we can't hold bonds in oppressive regimes, for instance, but that's not to say we hold bonds in oppressive regimes in the other fund. It's just that there's a specific screen on this fund. And the ethical fund has an advisory committee which is made up of clients in the fund which meet every 6 months to make sure that the policy continues to be appropriate, and I provide the secretariat for that group. So if you would like any more information on the work of that group, I'm very happy to do that. This is just a table looking at the performance of the two funds. The ethical fund outperformed the investment fund in the 12 months, so 13% versus 12. But over the longer term, the ethical fund is a little bit behind over the 10 years, so 9.2% versus 9.38%. And that's because if you have, for instance, alcohol doing well, then the investment fund will do better than the ethical fund, and equally when the reverse is true. So they walk a similar path, but maybe a slightly different pathway along that path. These are the objectives of the fund, which are exactly the same. So, and again, the asset allocation looks broadly similar, and the sectors that we like, because we're investing in the companies that we like, and the really boring income chart again. So I will pause there and ask if there's any questions.
We've got a British general election coming up. We've just had European elections, which may lead to individual ones in many countries. We've got American election in November. Will that help, hinder, or indifferent?
Yeah, it's a question we've been asked a lot, as you can imagine. I think the UK election will not make that much difference. We're sort of 6% of global markets. I would argue that probably a Labour victory is already priced into markets, and markets aren't spooked by their plans for the economy, etc. The bigger issue, I would say, is the US election, and whether a colleague referred to it as the looming orange shadow, whether we see Trump too. And the expectation is we will see a second Trump presidency. The issue this time will be he will carry on where he left off. So trade wars, we'll be looking at tariffs, reshoring, which are all inflationary. And He was inflationary last time, but against quite a benign background. Obviously, markets have had a lot of inflation in the last 2 years. It wouldn't be great this time, a second inflationary spike. So our focus continues to be on quality growth companies. So those companies with strong margins, the ability to withstand higher inflation, low levels of borrowing if we see higher interest rates. So the key is to be as diverse as possible. And if we did start to see weak markets, we would expect cyclical companies to do badly. So oil and gas, airlines, banks, for instance. And those are sectors which we aren't particularly have too much exposure to. Again, there could be questions, a bigger issue might be questions around how they deal with tech companies going forward. But again, we're looking at not just things like, we don't hold Tesla or Meta. We do hold Alphabet, Amazon, we do hold Microsoft and Nvidia, but also a lot of software companies and semiconductor companies. But yeah, I think 50% of the globe has elections this year, so interesting times.
Thank you, Jim. Firstly, can I thank you very much for your explanation. For someone who is non-financial, I almost understood everything you were saying. So thank you very much for that. I've got 3 questions, really. One, you've talked a little about the ethical investment, and I can understand that we don't want to see an investment in online gambling. I'm less convinced about alcohol because we look at some very reputable alcohol companies, and I think that we should, perhaps when you look at the whisky market, where we look at very, very significant exports of whisky, I'm not so sure whether I would agree about not investing in whisky. I want to make a small p political comment, and I want to be very clear that I'm not talking party politics, but it concerns me that we have a number of demonstrations which are continually going on in the UK, particularly relating to oil and similar sort of things. And I would want to feel that where we look at those as being essential of the future short-term marketplace, that we don't exclude them from our investments simply because there are demonstrations against them. And I would like to feel that we were looking at responsible investment in that respect. I do understand that there are some ethical things which we would not wish to invest in, and I would totally agree with that. I think you may have explained it, and I'm not entirely sure that with so much data coming out that I fully understood. If we go back to pre-COVID and where we've looked at the extremely volatile markets, I wondered whether we had returned back to the financial position that we were in prior to the market disturbance, and whether we were suffering from a fall in value or not. And then my last question is, when we look at the I think you said 12.46 million investment that we had. If we're looking at how we're going to be able to hold pace with what's going on, I think you explained, and perhaps you might just say something again about it, that we need to make sure that the fund is increasing and that we don't just look at a flat fund and just keep spending the investment where its buying power reduces dramatically. And I thought you might just say a few words more about how we were looking at the purchasing power of our investment over the future years. Thank you.
Thank you for that. So in your response to your question about alcohol, so we have the 2 funds specifically so charities can pick which fund best meets their mission. Because as you say, some will not be bothered about alcohol, others are. So that's why. So it's not us telling you what's ethical, it's charities telling us what's ethical. And that's the reason for having the 2 funds to allow that decision. The point about oil and gas, the ethical fund has a specific exclusions on not holding traditional oil and gas companies. So that has a specific exclusion on fossil fuels. And that's because the unit holders wanted that exclusion. So again, it's the unit holders in the fund telling us what is ethical. The reason for that being that many of the oil and gas companies are not going far enough, fast enough. There is issues around greenwashing. So this isn't political, this is purely on a financial and ethical basis. So there is an ethical screen on the ethical fund not to hold oil and gas because they aren't doing enough in terms of moving to a carbon-free economy. But the investment fund doesn't have a screen on oil and gas, but as a house, we won't invest in oil and gas because we think it's capital intensive, it is speculative. So your point about COVID, the oil and gas price collapsed because we weren't all taking flights or driving anywhere. So it's a price taker, it's dependent on supply and demand, it's not actually making anything, and it's becoming more expensive to get it out of the ground. So it is a financial decision in the same way that we don't invest in miners because we think they're capital intensive and price takers and speculative. So we prefer assets where you have a free cash flow, where you can understand the valuation of that business, which we would expect to appreciate over time. Now, if the Shell, we have held Shell and BP historically, but we actually divested in the middle of COVID because we became more concerned about practices and the share price over the long term. So it is done with an investment hat on. It's not that we are looking at what Just Stop Oil are doing. It is a financial case, and it's the same for miners. And again, the same for utility companies. We don't like utility companies. We think they're in capital intensive and they don't do a very good job with a captive market in many cases. And then you asked about COVID. So this chart, hopefully on the chart, shows the returns. So this doesn't quite encapsulate COVID completely because we're looking March to March. But you can see that post-COVID, we had a strong return in 21 and 22. 23 was weaker because obviously this would encapsulate the invasion of Ukraine and that spike in inflation, which was an issue for markets. But COVID was the sharpest and deepest recession in market history. So we saw a quarter where it fell 14% markets, and then they recovered 20% the quarter after. So it really was a sharp V, but markets have recovered and the funds have recovered in terms of performance. And just in terms of your other question around long-term performance.
Long-term value of the fund.
Yeah, long-term value. So this shows, I haven't got what the value of the assets was 10 years ago. I can dig that out for you. We can look at the unit price. But if we look at this chart, so the fund has returned 9.38% annualized, so per annum over 10 years. Of that, about 3% is income. So you've had about 6% capital growth per annum. And you can see that when we look at it against that CPI plus 5% target, so that's inflation plus 5%, that figure is 7.92%. So it's delivered above that. So it's protected you against inflation and provided growth, even allowing for that income that has been taken out and spent. So that really is the main aim of these funds. They are designed for permanent endowments to protect and grow that capital, but still allow you to spend today.
I mean, I think if we relate what we're hearing this morning to those of us who have small investments in ISAs, we've seen the collapse in value of ISAs and now the recovery. And I think we're reflecting much the same as that, aren't we? The one thing I was interested in, because we're a charitable organisation in the fund, does that have a tax benefit to us?
Yes, so the fund is a charity in its own right. It's a common investment fund. which means that it is ring-fenced and held by a corporate trustee. It also has a board of trustees to oversee our management of the fund. But it doesn't pay capital gains tax, it doesn't pay income tax, and on property, because we also have some property investments, there isn't stamp duty as well. So it has exactly the same tax benefits as if as you as a charity would have. And just on your point in terms of ISAs, it obviously depends what you're invested in. If we're talking about cash ISAs, then obviously we've seen that interest rate come back, having collapsed post the financial crisis, really, where we couldn't earn anything on cash. But now we can get, I have got a couple of slides on our deposit fund, and that's paying over 5%. So it's much better days to hold cash than it would have done previously. Thank you very much. Thank you.
Only to thank for such a detailed presentation. As in Councillor Smith, I'm not massively versed on the financial side of it, but I thought that was well presented. I understand that what you do ethically. It feels like the right thing to do. Simply to stay clear of such as online gambling, which does create quite a few social issues. So I think it's absolutely fine. And at face value, I must admit, inflation plus 5% seems quite ambitious, but you seem to be doing that. Perhaps I should let you manage my money, I think, going forward.
So just on that point, obviously it's done it over 10 years, but this fund has been running for 60 years, and it has done it over the decades as well. So
it's fair to say you haven't been running it for 60 years. Yeah. Yeah. But that's great. Thank you, Mr. Chairman. I'm very comfortable. A really good presentation. It's good when somebody comes along and presents something so simply, so something that can be so technical, so simply, so we can understand it. Thank you so much.
Thank you, councillors. Melanie, Helen, anything you'd like to add?
No, just to sort of, you can see why we feel that CCLA are the right organisation for us to invest charity funds with, and I hope that you've seen that assurance of what they're doing, what they're delivering for the charities, and actually that we can continue to provide that income for the charities which you look after. So just to reinforce that the recommendations from an officer perspective. Thank you.
Okay, we've got two recommendations actions. Read the first one. To continue to endorse the role of CCLA as our appointed manager. And then second really is that the committee limiting the investment of the permanent endowment of a charity fund to either the COIF Charities Investment Fund or where managing trustees request such the COIF Charities Ethical Investment Fund, both of which are managed by CLA.
Move the recommendation.
Moved. Okay, it's passed, we agree. Okay. Thank you very much to everybody on that item. We don't have anything at part 2, do we? No, just in case anything had been added. Okay, can I thank everybody for this morning and for a very succinct but very detailed meeting at the same time, so thank you.